What's up guys, welcome back to the channel. In today's video we're going to be jumping into the world of ICT concepts, specifically talking about the fair value gap strategy. This is a powerful tool that can help traders spot high probability setups and also boost profitability. This is the exact strategy that helped me get funded with my very first 25k Apex account. Before trading ICT, I was doing the break and retest strategy primarily with options. The thing though, man, with picking a strategy when you're first starting out with trading, you really want to pick a strategy that meshes well with your personality, right? The break and retest strategy, it's really good, man. It works, but the thing is, it takes time for the setups to happen, right? And for my personality, I like to be able to get in, get out. I want to be able to take multiple trades if they present themselves in a day. But with the break and retest strategy, it's more like for me, it was more like a swing kind of thing. And a guy, if you guys want to check out that strategy, specifically to break and retest, I'd recommend checking out a guy named Desiano. Man, what's his name? Let me pull him up real quick. But anyways, this guy on YouTube, he trades options using the break and retest strategy, and he's been killing it. I mentioned him in a video before. I believe he goes by Desi Trades. Let me pull over his profile over here real quick so you guys can go give him a look if you guys are interested in that kind of thing. Here he is right here, Vincent Desiano. This guy specifically, that's all he does is the break and retest, and this dude's been killing it. But like I said, you got to find something that really meshes with your personality. And for me, it just takes a little bit of time for these plays to play out, and I just needed something a little bit more faster, a little bit quicker. And you know, when I found ICT with the fair value gap strategy as well as the inverse fair value gap strategy, those really meshed well with my personality. So very key, man. Find something that works for you and then roll with it, man. But this is that guy's channel right here. A lot of good content, and like I said, this guy trades options though. But yeah, man, give him a shout, give him a follow if you guys want to check him out. But let's go back over to the video. So we're going to be talking about the ICT Fair Value Gap strategy. I'm going to be talking about more like the definition, what is it? Then we're going to go through a little bit of slides, and then in the end, I'm going to be showing you guys some live examples on the chart so you guys can actually see how powerful this strategy can be. But before we get started, if you guys want to go over and if you guys like the content, want to see more videos, go check out my new page. My name's John, and I go by Traders Hustle Inc. And yeah, man, go ahead and give me a follow and give me a subscribe, and let's get this back together. All right, so first slide is the bullish fair value gap, right? So first of all, what is ICT and what's the fair value gap? Well, ICT, or inner circle trading, it's a trading methodology focused on price action and market structure. One of its core ideas is the fair value gap, which is the imbalance or inefficiency in the price chart where demand outweighs supply or vice versa. These gaps typically form between 3 consecutive candles and can act as a key area of interest for traders. Basically what this strategy entails is you're going to have a few things that have to set up, right? You're going to have sell side liquidity, which is like a low, or on this specific bullish fair value gap, it's sell side liquidity, which is a sweep of a low, which is a sweep of the sell side, right? And then you're going to get a bullish fair value gap formed once we bounce out of that sell side liquidity. And right in here, you see you got candle one. Oh shoot, my bad. Yeah, wait, no. Sorry. So you got candle 1, candle 2, and then you got candle 3. And in the middle of these wicks, you got a wick here, and then you also got a wick right here. In the middle of these things, if you draw a little box like this shows, it's called the fair value gap, and that's an imbalance, right, in price action. So usually what happens is the price will take off past this and create the fair value gap, and then the price will retrace back into this fair value gap. And whenever it enters this this box, right, that's where you want to go ahead and take your entry, right? So this thing says a 1 to 2 risk reward, but really it could be a 1 to 3, 1 to 4. What I've seen on this strategy in particular is I mean, some of the risk to rewards can be like crazy, man, like 1 to 5, 1 to 6. Like this thing can run if you catch it right. And you really want to find these plays on a lower time frame. Mainly I'll take my entries on the 1 minute, but you can see them kind of setting up on the 15-minute chart. So like I said, once we get into the charts, we're going to go ahead and talk about that more. But let me see what else we got here. All right, so we're just going to go ahead and go to the next slide, and we're going to talk about how does the fair value gap strategy work. So basically the strategy revolves around identifying these gaps and using them as points for potential entries. When price revisits a fair value gap, it often acts as a magnet, creating opportunities to enter trades in line with the prevailing trend. So just like I showed you in that previous example. And then it says, for example, in an uptrend, a gap between a bullish candle and the wick of a preceding bearish candle could indicate where buyers are likely to step back in. So back to the example, what it's talking about right here is this, like I said, candle 1, candle 2, candle 3. The space in between is the bullish fair value gap. That's how it's formed, and that's where it's indicated by this gray box. And the cool thing about TradingView, we'll go ahead and jump on the chart here in a little bit, and I'll show you how you can set this up, is it lets you map, like you can use the little tool. It's like a little rectangle tool, and you can map out these boxes, right? And you can have it to where you can make it like there's an option where you can have it extend all the way to the right. So if the fair value gap entry doesn't form like right away, it'll still carry on like throughout the chart in case it happens like in 5 minutes or 10 minutes or whatnot. But usually they kind of happen pretty quick. But that's just a cool little trick you can use in TradingView. But anyways, this is that box we're talking about, and this is the entry area where the risk is pretty much defined, because once you take your entry here, your risk is pretty much, the way I like to do it is I'll risk my right here at the bottom of this candle. So that's where I'll have my risk, and then like I'll have my reward at that next draw on liquidity, wherever it is up here. Usually what I'll do is, let's say I take usually I'll trade the micros, and if you guys are new to futures, I trade the micro NASDAQ contracts because I can take more contracts without because if you take the minis, they move. Like what I'm trying to say is that I can scale out more using the micros than I can with the minis. So for example, if you trade one mini contract for the NASDAQ, it's like trading 12 micro contracts. So if you were to take one mini, you can't really scale out because you only got one contract, right? But if you trade the micros, you can take 12. So then I can scale out like half or 3/4 or whatever I want to do. So it just allows me, as a little tip, allows me to scale out of my positions and keep some runners for potential bigger moves. So usually what I'll do is I'll enter here, and then like I said, I'll have my stop at the bottom of this candle, and then I'll have my take profit at the first sign of the nearest liquidity, right? It could be an old high over here, or it could be another fair value gap that's up here somewhere, because usually that's where price is going to want to go, because like I said, once it takes out this sell side liquidity, it's looking for the next form of liquidity, right, which is going to be on the buy side, and it's usually going to be a prior high, or it's going to be another fair value gap up here that's left open, right? What I mean by open, meaning it hasn't been touched. So that's usually where price is going to try to go, and that's usually where I'll have my first take profit. And once it hits that first take profit up here, I'll go ahead and move my my risk to break even after I scale out. So once it hits that first take profit, I'm going to go ahead and scale out of my position. I'll probably take half off or 3/4, and then I'll leave the rest to run. I'll move my stop to break even, and then let the trade ride out. So that's how I can kind of maximize on the moves, right, and then limit my risk all at the same time. So let's go ahead and see what else we got here. Just wanted to jump in real quick one more time, go back to this example. Another way that you could do it, as far as, you know, where you want to take your first take profit and then go ahead and move your stop to break even, is actually right here too, because this would technically be your first draw on the liquidity, because it is technically an old high, and over here it's kind of like a double top almost, so like a double high. So you could actually go ahead and take your first TP right here, and then go ahead and move your stop to break even. Okay, because let's say there's another level up here, right? But this is actually your first one. Okay, so just wanted to throw that in there, that on this example, this would probably be a better take profit for your first one, because once it hits this, since it is kind of like it could be a double top up here, it could retrace all the way back down and then, you know what I mean, stop you out and whatnot. But if you take your first TP here, move to take profit, that's still a pretty good move, right in here. It's probably like 10 15 20 points, who knows if you're on a 1, or you know, if you're on the 5 or 3, whatever you're looking at. But definitely try to get your first TP right here. Okay, just wanted to step in and say that real quick. All right, back to the video. Okay, so why is it profitable? Fair value gaps help traders identify areas of institutional activity. By aligning your trades with these key zones, you're essentially following the smart money. This increases your probability of success compared to trading blindly. And that's really key, man, because if you watch any old heads on YouTube talking about, you know, trade the trend, you know, don't go counter trend. Basically what they're trying to say is like, follow the smart money, right? Follow the banks, follow the institutions, because they're the ones that move the market, right? And now once you learn ICT and what it's all about, right? The market is chasing liquidity, right? So it's chasing old highs, old lows, looking for basically orders to get filled, right? So that's what it's chasing. And if you follow the smart money, then you're not gonna be dumb, right? You're not gonna get how do you say it? Like, you're not gonna get ran over by the train, right? So just stay on the tracks, go with the trend, go with the flow, don't fight the trend. What else does it say down here? It also provides clear risk management, since the boundaries of the gap can define your stop loss and target levels. So like I said, just like I showed you here, this is defined risk, right? Because if it comes out this box, it's primarily, if it closes below this candle right here, then you're out, right? So you have a nice little area of where you're risking, because if you don't have this kind of strategy or whatnot, you really don't know where your stop is. You know, you're basically going to 20% stop loss or whatever. But I like to know, like, hey, if it goes past this candle, I'm out. So that's pretty cool. So we're gonna go ahead and take let me see, let's take a look at this bearish fair value gap before we go to the tips for success. So with the bearish fair value gap, instead of having that buy side, that sell side liquidity, we're going to be looking for a buy side liquidity sweep. As you can see in this little box here, say this was the old high, we went up, we kind of swept it, right? Which is saying right here, buy side liquidity sweep. And then we got that nice momentum move down. We got candle 1, candle 2, candle 3. If you go from the wick of this to the bottom of, where is it at? Well, usually there would be a wick here or something, right? So then that's where you draw your box. So this one came a little short, but say there was a wick right here, you would just draw the wick right here, or you can do the body, the same thing. So go ahead and draw that out. And then once price returns into this fair value gap, right, this box, that's when you go ahead and take your trade. You put your stop loss at the top of this candle, and you go ahead and target your first TP at the nearest liquidity down here, which would be, like I said, an old fair value gap that hasn't been touched, or old low or something like that down here. So let me see, what else do we got here? Oh yeah, real quick, man. I learned this from a guy, I think his name's Carlos Trades or something like that. Let me see what his name was. One second. Carlos. He trades Forex, but yeah, this dude right here. He trades Forex and whatnot, but he's the one that kind of showed me this really cool thing. It's this guy right here, FX Carlos. He kind of trades the same system. Sorry about that. He kind of trades the same system and whatnot. So if you guys want to check him out, go ahead and check him out. Give him a subscribe or whatnot. I am subscribed to him, but like I said, this is my YouTube channel, so I'm not subscribed to him on this channel. But anyways, he's the one that showed me a lot of times when you get these fair value gaps, man, when price retracts back into this gap, most of the time it's not going to come all the way like it's showing right here. If the way it's explained is, if it's a really powerful move back down, you're probably going to come, like, it's probably going to retrace like right to here, and then it's going to go down. So if you're over here waiting for it to come inside the box, most of the time, if it's a strong move, it's not going to happen. And then what happens, that the thing is going to move without you, and then you're going to end up on in a chase. So what he said was, and it's played out a lot of times. So like I said, I'm going to put you onto this. He says to go ahead and put your little limit order right here, because on TradingView, you can already have your setup here, right? With your stop loss already, with your price targets already mapped out. And you'll go ahead and have a sell limit here, right? To go short. Sorry about that. You'll have your sell limit right here to go short, with your stop loss up here, and then your take profit down here. Because most of the time, if it's a strong move, it's not going to come all the way in the box, right? So definitely have it right here, or that's the way I'm going to do it, and I've been doing it. So have it here, and then have your stop out here, because most of the time it's not going to come all the way in, and then you're going to get left behind. So speaking of the box though, the way that it's taught is, if the price doesn't even come to the box, then that means it's a really, really strong move, right? And that's why you want to have your entry right around here, because you don't want to get left out. But if it comes like wherever this box is on TradingView, you can have a line in the middle, and ICT calls it, I forgot what it's called something. I forgot what the name is. I'll go ahead and put it in here later, but it's like consequent encroachment or something like that. And basically what happens is, if the retrace into this box stays below half of this box right here on the bottom side, that's a really good thing, right? But if it starts going above half of this zone, then it's kind of looking like a weaker kind of play, right? Like it could still probably work, but the probability is a lot lower if it goes on if it hits the top of this box, or if it starts going higher than the middle of this box right here. So just keep that in mind. But anyways, let's go ahead and check out the tips for success. So remember, not all gaps are created equal. Combine this strategy with other ICT concepts like market structure and liquidity zones for higher accuracy. Always backtest and manage your risk properly. So yeah, definitely do these things right here. What else do I got? So I got a fair value gap checklist before we get into the charts. So number one, you want to really make sure you're trading at the optimal time for these setups to happen, and it's usually around the 9:30 to 11 a.m. Eastern New York session. And they also call these times the kill zone. And on TradingView, there's an indicator that you can put on, and I'll show you that'll map out these kill zones for you, so you don't have to worry about it. And then number two, you want to look for liquidity sweeps, and that's going to be a major liquidity sweep of the London or Asia high of day or low of day. And like I said, with that indicator I'm going to show you here on TradingView, it'll map these out for you, so you don't have to worry about that. And then you're going to want to clear areas to target. So you're going to want to have profit targets and take profits already mapped out and identified. So look for clear draws on liquidity above or below the entry. And then of course you want to have good risk to reward. So always set a good risk to reward and move to break even once first TP is hit. So my bad, PT, but take profit is hit. So yeah, so that's the checklist. Go ahead and screenshot that, or print it out, whatever you want to do. So now what we're going to go ahead and do is get into the charts. So give me 1 minute, I'll be right back. Guys, so here we are on the charting software. I use TradingView. This is a subscription model that I pay about 15 to 18 bucks a month. I'm not too sure on exactly how much it is, but they do have a free version. But if you want to throw in more indicators and moving average and all that, if you throw more than like 2 on there, then they'll go ahead and want to charge you, right, for the subscription. But they do have a free model. But if you want to add a lot of stuff to it, you are going to have to pay. So anyways, let me go ahead and show you guys an example of a bullish fair value gap setup, and then also of a bearish fair value gap setup. And this is on trading action for December 28th at about 11:34 a.m. but this price action obviously was earlier, about 8:30, 8:45. Like I said, in between that kill zone of 8:30 to I'm sorry, what is the east, because I'm in Texas time, and I believe it's Eastern time. So yeah, 9:30 to 11 a.m. Eastern time. Okay, but like I said, I live in Texas, so I'm an hour behind. So let me show you guys how this works real quick. You see this right here? This is the London session, and this is that indicator I was telling you about. It's called the where is it at? This one's called the previous day highs and lows, and I'm gonna go ahead and, no, that's not it. It's right here. I'm sorry. It's this one. right here. Let me go to settings. Yeah, this one's called the ICT Kill Zones and Pivot Points by TFO. So if you guys go into your indicators right here, you're going to go ahead and type in what I just said, right? The ICT kill zones, and then this thing right here should pop up. And the reason why I have it highlighted with the gold star is because I have it as a favorite, so I don't have to go back and look for it. But this is the one you're looking for, guys. It's made by this guy right here, and it's got this many, I guess, downloads, right? So there's other ones, but you just want to go ahead and grab this one. So go ahead and click it, and it's going to populate on your charts right here. And then if you go into the settings, which you just click this right here, what I do, just go ahead and look at this. I'm going to go down so you can screenshot it, but just set everything up. It should already be set up, but go ahead and take a look, make sure your things match this. What I do is these will be checked. I go ahead and uncheck. These will be checked like this. I'll just go ahead and uncheck all those. These are the only ones I want to see. Don't mess with none of this stuff. It's already populated. So yeah, that's pretty much all I changed and whatnot. So leave everything else the way it is. Like I said, take a look at this, make sure it matches. So once you got that set up, push OK. I go ahead and hide that. And then, so what it's going to do, it's going to map out that London low, and it's going to map out the London high, but it's also going to map out the Asia low and the Asia high. And why do you want to do that? Because you want to, these are going to be your major draws on liquidity, right? A lower draw on liquidity and a higher draw on liquidity. So, and then also real quick, sorry about that, I have the previous day high and low mapped out, and that indicator is going to be this one right here. So if I turn it off, you see the green line right here, it disappears, you see? So that's also a one you want to have on your chart, just because, like I said, it is a high liquidity draw depending on where we are when we open, right? So definitely have those on your charts. So let me go back to this example. So once you have your London low here, right? And then you have your high up here, and you have your true day open. That's also very important. Like I said, I'll make another video on these other indicators, but right now we're just gonna focus on this. Right now, what I like to do is, you see this line right here, it's not gonna be on there right away. So what you're gonna have to do is, you're gonna have to use this horizontal ray, and you see the London low, the line is not extending. So you can get that horizontal ray, come back up, tap it there, go up there, change it to red so it matches the London low color. And now what I also like to do is I want to go ahead and type in that this is going to be the break of structure, because remember guys, you kind of want to be anticipating what the moves could be, right? So break of structure, if I could spell structure, like that. And here you can change it to big, or you can make it small. I like it around, do it right there because I'm a little bit blind. So we'll go ahead and move that here, because like I said guys, you want to kind of be anticipating what could happen, right? So London, the market opened here, we got to run up, right? And we know this is a big draw on liquidity, right? So once we start coming down, I mean, I would go ahead and type that in, like, yo, if we get a break of this, I'm looking for this, 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 and this. So go ahead and type that out. Now let's go ahead and play it out and see what happens. So here we go. Boom, see, we got that big drop down. Now let's go ahead and keep on watching and see what happens after that. So here we go, it's still going down. Now we're seeing a pop up, we're still running, and then boom, we're getting a break back above that structure, right? So now that's a pretty good, these are pretty good momentum candles. The volume's pretty high, right? So that's what we would like to see. So let's go ahead and keep on playing it out and see what happens. So let's keep going. Boom, boom. All right, so right in here, I'm already seeing that we let me move this out of my way. Right in here, I'm already seeing, hey, we got the break of structure, right? We broke the London low. So this is that draw on liquidity that we got. We have a big run up, right? The momentum's coming up, and the volume here is increasing. So now we got good volume, we got the break of structure, we got a bullish run up. If you guys are enjoying the content so far and you're liking what you're seeing, don't forget to like this video, share it, comment down below what you want to see next, and most importantly, don't forget to subscribe. And I appreciate you guys sticking around, and we'll get back to the video. So everything's looking pretty good. So now what are we gonna do? We're gonna go ahead and start looking for, let me take this off. we're going to go ahead and start looking for the fair value gap, right? So where is the fair value gap? The ones I like to look for, because you can have like a little one in here and then you have another little one in here, but the one that is more powerful is the fair value gap that will form at the break of structure, right? So I'm going to go ahead and map this one out. So you want to get that bottom. So you got 1, 2, 3, and then here's the gap in the middle. So go ahead and get this rectangle tool, and you're going to go ahead and map out from that bottom wick over here to the bottom the top of this candle wick, and then just drag it across, and then boom. So look, we have that fair value gap right on the break of structure. So that is like really powerful. So now what we're going to be doing is we're going to be waiting to see if price can come back into this fair value gap. And if you guys remember, we're going to want to have an entry kind of in here with our stop loss below this candle. So this is kind of what we're going to be looking for if we can get it, right? So we got to see if price can come back in. So I'm going to go ahead and set this up, and this is how I would do it. I have my limit order ready to go. So I'd have it with my stop loss right there, because that'll be a close below that. I'm out. And then my profit target would be probably up in here, either here or here. So for now I'd be here, but it just depends, because if this comes back down, then this could be your first TP. So I'd go ahead and be like, yo, if it worked out the way I wanted to, that would be my full take profit. And then I'd go ahead and map out, let me go ahead and map that out. I'd go ahead and map this one out. And then if this one does reverse, that would be another one. So that would be my first one. And I like to turn these to white. I don't like them red. So I turn those to white. Kind of like that. All right. And so now what are we doing? We're going to go ahead and wait to see if this will come back in and fill us in this fair value gap, right? And remember, we're looking for a good move. It's going to be at the top range of this rectangle. I'm going to zoom in a little bit more, because you see this line right here in the middle. You can set that up by going to settings, and you're going to hit this middle line, right? So that's going to dot out that line, because remember, if anything is below, it's a little bit weaker. You want it to kind of bounce out in this top range of the rectangle that you have. But as long as it's in here, it should still work. But you just don't want to close below this at all, because then it invalidates it. But if it's up in here, then it's really powerful. If it don't even hit it, then that's even more powerful. But that's just something to look for. So here we go. All right, so let's play it out. Let's see what happens. All right, we're coming down, back up, consolidating. Here we go down, and then boom, right in here, we kind of tap that box, right? So you would technically be in. So now that we're in, this now becomes, you can adjust this. So this would be right around your first take profit, right? You can either do the wicks or you can do the bodies. It's up to you. Just go ahead. I'll just do like right in here. Right, but if it's in this area and it starts showing weakness, I'm gonna get out. I'm gonna go ahead and take that TP and then move to break even. So boom, now we're in. So let's see how it plays out. All right, and then boom, we got that bounce off, right? So everything is looking good. We're in the green. Now we're coming back down, going back up. See, so it can chop around for a little bit, but you're just chilling, man, because you got your as long as they don't close below here, you're good, man. So we're just chilling, we're watching. All right, now we're making the move up, and as you can see right in here, we're pretty much at TP1, right? So like I said, you can either do the body or you could do the wick. It's up to you. Either way, I would go ahead and take that TP1 off, and then I would go ahead and move this to break even. So now that TP got hit, right, the first one. So now we're break even. So right now this is the free trade. So let's see what happens. Let's see if we go run up in here and hit these, or if we come back down and get stopped out. So let's see what happens. Right there, boom, for sure we hit this first take profit. For sure we hit the top of the wick. So we're good. We already took our money. So now we're chilling, coming back down. Now we hit that second TP right here. So I would have taken a little bit more off right there. See what happens. We're still going. Boom. We would have been fully out right here, or you could have taken more off and left a little bit of runners. Like I said, if you trade the micros, it allows you to have more to scale out a little bit more, right? So that's why I like to trade the micros. But boom, you would have been all out, and you pretty much never went into drawdown in here, not at all. So that is a pretty good example of your bullish fair value gap. Now we're going to go ahead and take a look at a setup for a bearish fair value gap setup. So give me 1 second, let me find one. All right, guys, I'm going to go ahead and show you the bearish fair value gap setup, but this is going to be a little different. This is actually going to be on a 3-minute chart, and it's not going to set up right away, but I just want to show you guys that it doesn't necessarily have to be on a 1 minute. You can actually be on a 3-minute too, because sometimes these big moves like this, you see they'll give you fair value gaps, right? But they won't give you a pullback into it. So sometimes you got to be a little patient and wait for a move to set up. So this is going to show you an example of a move that sets up a little later on, but you can see the concept still work the same as far as you know, the entry pattern and whatnot. You know, you want it to come into the gap, and then you're going to see the rejection points and hit your take profits that are going to be down here. So let's go ahead and play this out, and then we'll see how it works. All right, so here we go. I'm gonna go forward, so you guys can see we got some big moves down, and right in here you guys see that we do have another fair value gap, a bearish fair value gap setup. So we're going to go ahead and draw that out. And this is what I was talking about with this tool right here. If you go to settings, you can go extend to the right, and you see that it basically maps it out all the way to the right. So like I said, if you're looking for a move, or if you're trying to be patient and nothing's setting up like up here, and you know, hey man, over time I know these moves tend to come back and test these fair value gaps that are left open, definitely have that extension on, so you sit back and watch and see if price comes back into your zone up in here. So we're going to go ahead and keep on going forward and see how it sets up. So here we go. We're still going down, and we're getting some chop here. We got a little double bottom down here. Looks like we're trying to come back up, playing around down here, and then boom, right in here, guys. So right in here is where we're starting to tap that fair value gap. So you could have your limit order somewhere out in here. Once you see this big move starting to break this right here, you can go ahead and start like anticipating, like, hey man, we could be getting a move up in here. I know, look at this huge drop, right? I mean, we just melted, and then we had a little retracement here, and then boom, just started melting. So you guys, you know, it's a bearish sentiment, right? So just be anticipating that this could come into this fair value gap, and this is definitely one that was left open, and you definitely want to, you know, you want to try to take a stab at it and see how it works out for you. So start setting yourself up there, right? You're gonna go ahead and have your entry in here, just in case it doesn't fully come in to tap this fair value gap, because remember, if it's a strong move, it's not going to come all the way in here. So go ahead and set it up like I'd set it up like this, and then have your stop loss above there. And then now you have these zones down here, right, that you can go ahead and map out and target. So that would be like my overall take profit right there, and then I'd probably have another one right in here like that, right? And just anticipating the move, right? And so let's go ahead and play it out and see how it happens. There we go. So we tapped it there. Now we're coming down. Everything's looking good. Coming down to that take profit one. Boom, we smashed it. So now you're in here. You hit your first TP. So go ahead and move your stop to break even. So now you have no risk on it. You took some profit off the table, and then you're gonna hold until hopefully we get these two. This is basically a big draw on liquidity right here on this downside, because you have two double bottoms right here. So you have a double bottom, so price more than likely always wants to come and try to tap these double bottoms right here. I mean, that's what we're looking for, right? So that's why we have that last TP right here. So let's go ahead and play it out and see if we get that full take profit. Bouncing around a little bit, and right in there, boom, we smashed it, guys. So we hit that last take profit. So now we should be all out, or if you guys want to hold runners, you can do that too. But yeah, so that's how this longer term bearish fair value gap would set up. And like I said, this is on a 3-minute. It still works on a 3-minute, guys. You don't necessarily have to be on a 1-minute or the 30-second tick chart. You could definitely do it here on the 3-minute too, right? So there's the examples, guys. I hope you guys enjoyed the video. If you guys want to see more in-depth I guess videos on other topics as far as strategies and whatnot with ICT, go ahead and drop me a comment down below. I am going to be making a few more videos regarding the inverse fair value gap strategy that I trade as well. And yeah, man, I hope you guys enjoyed the video, and we'll catch you on the next one. All right, we out.